The CPI inflation report for the month of March was released this Wednesday morning, and we saw a huge improvement, at least in the headline CPI figures. So it was at 6.0% in February, and it fell to 5.0% in March. So despite this huge drop, we're not seeing the stock market react so enthusiastically. It's not thrilled. Right now, at the time of making this video, the stock market is flat, and I'm going to tell you why. So yes, the headline inflation figure, it fell dramatically from 6.0% to 5.0%. However, core inflation, it actually ticked up higher from 5.5% to 5.6%. Core inflation, that's when you strip out certain things. We're talking about food and energy prices. So that is concerning because energy prices are on the rise. You probably see it, at the pump. So yes, the headline figures, they show big improvement because if you think about it, if you remember around this time last year, oil prices, gasoline prices, they were at ridiculously high levels. So this is around the time when Russia invaded Ukraine and oil prices shot up, and accordingly, gasoline prices. So when you compare this March compared to last March, there was a big drop in oil prices, and that's helping the headline figures out a lot. But of course, it's not helping out core figures. So the Federal Reserve explicitly says that they prefer to use core inflation as a better gauge of inflation. And so that's the tool that they're using to see their progress on the fight against inflation. So now the Federal Reserve, they have their meeting coming up on May 3rd. They're either going to raise interest rates by 0.25% or they're going to pause at that meeting. Before this CPI inflation report was released, the probability of the Fed raising interest rates by 25 basis points was 72%. After this report, so right now, the probability has increased to 73% of an interest rate increase. So that's the expectation. The expectation is that the Federal Reserve, they're going to raise at their next meeting. So that's why the markets are not thrilled about this report, despite the sharp drop in headline CPI. So I'm going to dedicate a separate video to the Federal Reserve's May 3rd decision, their meeting. But today I want to focus on the actual reports, and so here are the breakdowns of the year-over-year stats. So energy prices are down 6.4%. Services ex housing is up 7.1%. Shelter up 8.2%. Food up 8.5%. So let's break down these categories one by one. So beginning with food, we have an inflation rate of 8.5%, so still very high. They're saying that month over month, food prices stopped going up in March. So let me know if you agree with that, because that's what the report says. It says from February to March, the price of meat fell by 0.3%. Fruits and veggies fell by 1.3%, and eggs fell by 10.9%. So that's month over month. But now I want to give you the year-over-year stats. Year-over-year stats, butter up 8.7%, milk up 5.5%, coffee up 10.3%, bread up 15.2%, eggs, they're still up 36%. Now moving on to energy. So this is the category that I guess you could say kind of threw off the headline figure. It's kind of skewed, it distorted it in such a big way. And that's why people are paying more attention to core inflation in this March report. So just remember that. So energy is down year over year 6.4%. That is a huge drop. So year over year, but then when you look at the other categories within energy, for example, electricity is still up year over year 10.2%. Utility gas service is up 5.5%. Gasoline prices are down 17.4% year over year, but month over month, they're going up, and they're expected to continue going up. Now let's take a look at shelter. Shelter is up year over year 8.2%. It was actually up 8.1% in February, so it's actually going up higher, at least on the reports. Shelter inflation is going up on paper, so in the CPI reports, and I don't know if you caught this in my last video, but as I explained, we are not going to see, well, this is my expectation, we are not going to see improvements in shelter inflation for another 2 months or so. So it's got to do with the way that shelter inflation is calculated in their reports. So shelter inflation, it's slower to rise and it's slower to fall in the reports compared to the real world. It's because the way they calculate it, it's smoothed out because the shelter calculation, it uses existing contracts, and that's going to be a distortion from reality because in reality, well, you're going to be looking at market rates. So that's going to cause a lag in shelter inflation in the CPI reports. So I hope that clarifies it. Now moving on to services inflation. So this is services X housing. It is up year over year 7.1%. This one's very important. This is probably one of the I would say probably the most important component that the Federal Reserve is focusing on right now. Okay, so we're talking about the labor market. This ties in with the employment data. So the Federal Reserve has been concerned for some time about the overheating labor market, which is driving wage inflation, which contributes to services inflation, which contributes to overall inflation. So we saw a strong jobs report in March, 236,000 jobs added. So this is why we're seeing services X housing still elevated at 7.1%, above the 5.0% headline figure and well above the 2% target that the Federal Reserve is looking for. So we saw little improvement here from the 7.3% in February. Now this CPI inflation report, it is so important. It is one of the 4 crucial pieces of information that the Federal Reserve is going to be basing their decision on for May 3rd. The 4 things that they're going to be looking at and analyzing is, okay, the CPI reports, the jobs report for the month of March, which we covered, bank stability, and credit flow. I'm going to put together an analysis for you. I'm going to get back to you tomorrow. But the Federal Reserve meeting on May 3rd, it's going to be more than just a question of will they raise interest rates or not. I think we all want to know, when are they going to start cutting interest rates? So we're talking about the Fed pivot. When will they start printing money again? So temporarily right now, yes, they have started that process. They've been printing money again. But I'm talking about, okay, so that's temporary. But I mean, when are they actually going to really start that process up again and start printing aggressively? Moving on, I want to give you this information. This is coming from the Federal Reserve Bank of New York. This is from their monthly microeconomic data report for the month ending in March. The expectation is that in 2023, the price of gas, food, rents, and medical care will continue to go up. But they're saying that the good news is that those items, yes, they will continue to go up in price, but they're not going to go up as fast as they did in 2022. For the cost of college education, that's actually expected to go up faster, so accelerates compared to 2022. Home prices are expected to rise. However, growth expectations are below pre-pandemic levels. So I cover home prices once a month. I know that some people are rooting for a housing market crash, and I understand why. I completely get it. Home affordability, it's in a bad spot. It's so unaffordable for people that are looking to buy a home. So when you take a look at the housing market situation, not only did prices shoot up, drastically compared to pre-pandemic levels, but now you have interest rates well above 6%. That just makes it so unaffordable. So if you're interested in home prices, please check out my monthly videos. I just make them once a month. But just so you know, home prices have gone up month over month from January to February. I would attribute that to seasonality, but that is the expectation. Modest gains or losses, but not something drastic, not a housing market crash. You don't have to agree with that forecast, but please check out the videos because I dedicate the video to that. So it's a very detailed video, detailed videos. Okay, when we're looking at the labor market, the report shows a 40% expectation that unemployment will be higher 12 months from now. To me, that is surprising. It's surprising that it's not higher because Fed projections show that the unemployment rate will be at 4.5% by December. We're currently at 3.5%. So the report says that people ages 40 to 60 and people making between $50,000 to $100,000 a year are most concerned about losing their jobs. So that's relatively speaking in comparison to other age groups and to other income groups. So if you're in that age group or income group, if you could, let people know why you or your peers feel that way, that'll be helpful. Now let's review household finances. Household income is expected to grow by 3.3% this year. That is awful. Because think about it like this. Income grows at 3.3%. Inflation right now is running at 5.0%, or you could say 5.6% if you look at core. That means that inflation, our expenses, are going up faster than wages. That means that real wages are declining. That means that our purchasing power is declining. So that's the same thing as getting a pay cut, which I interpret as a lower standard of living. And that's been the norm for all these years, negative real wages, and for many years, and it keeps building up, and it adds up meaningfully. Okay, let's talk about household spending. So households are expecting to spend 5.7% more this year. And this is just strengthening that previous arguments, that households are expecting to spend 5.7% more and expecting income growth of 3.3%. So people are expecting to spend faster than their incomes are rising. And here's another thing. We've covered all the trouble with the banks. The banks are holding a lot of assets that are underwater, and they're tightening up, and credit is slowing down. Credit flow is slowing down. Households are reporting that it's now harder to obtain credit right now compared to 12 months ago. The expectation is that it will become even more difficult to obtain credit this year. So analysts and economists are saying that, well, this could be a good thing because it will help to bring down inflation. The way that they're looking at it is that if people cannot get loans to buy cars, to buy homes, to buy whatever items, then demand will go down and inflation will go down. So I guess it works like that, but that's a depressing way to bring down inflation. But technically, I guess they're right. I personally think that it would be better to bring down inflation by increasing production, but we're going to go with their plan, the other plan, crushing inflation by crushing the American people. And the last thing is that, okay, in 2 weeks, we will see how the economy did in the first quarter. The expectation is positive GDP growth of 1.5%. That's Q1. So it's still going to be in positive territory, but Q2 is expected to come out worse. So in terms of predictions, in terms of how we're going to do in Q2, obviously, we're in April, so it's very early, but we will get some major clues because companies are now reporting their Q1 earnings and their Q2 expectations. We're in earnings season. So that's it for today. I will be back here tomorrow for an updated report regarding the stock market and the Federal Reserve. Please be sure to subscribe. If you're an investor, please check out our website for exclusive investing content. I'm going to leave a link down below. Thank you for all the support. I wish you a very nice day. Please take care.